During 2026, households across advanced economies are making financial decisions that will quietly determine their economic survival for the next decade. In 2026, private investors are concentrating record capital into assets priced for perfection while ignoring risks hidden in plain sight. During 1929, American investors made the exact same decision. Within 3 years, nearly 90% of stock market value was erased, and the global economy entered its deepest contraction in recorded history. The consequence was not sudden, it was mathematical. So the central question becomes unavoidable. How did we arrive at this exact moment again? History has witnessed this precise sequence before, not once, not twice, but repeatedly across empires, currencies, and centuries. The names change, the instruments evolve, but the underlying investment mistakes remain remarkably consistent. Most people believe financial collapse begins with a crash. Historical record shows something very different. Collapse begins years earlier, when capital flows into the wrong places at the wrong time, under the illusion of safety. This video will identify 3 investment mistakes that appear harmless in real time, dominate behavior at financial peaks, and only become obvious once wealth destruction is complete. These mistakes helped undermine Rome, Imperial Spain, and Weimar Germany, and today they are reappearing with measurable precision. This isn't speculation. This is over 2,000 years of documented monetary history. Let's begin in AD 96. When the Roman Empire controlled nearly 5 million square kilometers and governed over 65 million, people roughly 1/4 of the world's population, Rome appeared invincible. The mistake was subtle. To fund military expansion and social programs without raising visible taxes, Roman authorities began debasement of the denarius. In AD 211, the silver content stood near 50%. By AD 260, it had fallen below 5%. That is a 90% reduction in real monetary value. According to historian Edward Gibbon, the finances of the state were exhausted by the improvident profusion of the emperors. Prices rose, trust declined, savings evaporated. The result was not instant collapse. It took nearly 150 years. But by AD 476, Rome's Western economy had fragmented into barter systems. Military loyalty collapsed, and imperial authority dissolved. The first investment mistake, trusting nominal stability while real value is being diluted. Now, 15 centuries later, Spain faced a similar crossroads. In 1580, Spain controlled the largest global empire in history, fueled by silver shipments from the Americas. Between 1500 and 1650, more than 180 tons of silver entered Europe. The assumption was simple. More money meant more wealth. Instead, inflation averaged 2 to 3% annually, devastating in a pre-modern economy. Domestic industry collapsed. Spain imported goods rather than producing them. Government debt quadrupled between 1550 and 1600, according to economic historian Earl Hamilton. The influx of precious metals raised prices faster than wages, undermining Spain's productive base. Spain defaulted on its debt 6 times between 1557 and 1647. Collapse arrived faster than Rome within 120 years. The second investment mistake, mistaking windfall gains for sustainable wealth.
Trillion. According to the Reichsbank, money supply expanded by over 1 trillion% in 4 years. Asset prices soared. Stocks appeared to rise endlessly, but real purchasing power collapsed almost overnight. By the time citizens realized the pattern, it was 12 months too late. Savings were annihilated. The middle class disappeared. The third investment mistake, chasing rising asset prices during monetary instability. Notice the sequence. Phase 1, fiscal stress and rising obligations. Phase 2, monetary intervention masking the problem. Phase 3, capital misallocation followed by collapse. This isn't coincidence. This is economic certainty backed by over 20 centuries of evidence. The pattern is mathematically consistent across dozens of documented cases. So how does this connect to 2026? Consider the metrics. Roman Empire. Silver content fell below 10% before systemic break. Down. Spain. Debt exceeded 150% of crown revenue before repeated defaults. Weimar Germany. Money supply increased 1 trillion% before currency collapse. Modern economies. 2026. Global debt exceeds $310 trillion. Over 330% of global GDP now examine investment behavior. In the past 4 years, equity valuations in major indices reached price-to-earnings ratios above 30. Housing affordability hit its worst level since 1982, and government bond yields inverted for over 18 consecutive months, according to the Bank for International Settlements. Extended periods of debt expansion combined with asset inflation historically precede financial instability. If we position modern markets on the historical collapse timeline, we are currently at stage 2 of 3, the stage where confidence remains high, volatility appears contained, and capital concentration accelerates. Here's what's remarkable. In 1928, margin debt surged 40% in 1 year. In 2006, U.S. housing prices rose 11% annually, while wages stagnated. In 2024 to 2026, speculative assets and leveraged instruments again outpaced income growth by more than 3 to 1. Remember the unanswered question from the beginning: how did people fail to see this coming? Most people won't see this pattern until it appears in retrospective analysis. The 3 investment mistakes revealed. Mistake 1. Treating liquidity-driven price growth as real value. Mistake 2. Over-concentration in assets dependent on perpetual stability. Mistake 3. Ignoring historical drawdown durations. Assuming rapid recovery. According to Ray Dalio, the biggest mistake investors make is believing that what happened in the recent past is likely to persist. History doesn't repeat, but it rhymes with precision. History reveals 3 possible outcomes. Path 1. A rare soft landing seen in roughly 10% of historical cases, where imbalances correct gradually through productivity growth and fiscal restraint. Path 2. The most common outcome, about 70% of cases marked by prolonged stagnation, lost decades, and slow erosion of purchasing power. Path 3. A severe reset, approximately 20% of cases featuring rapid asset repricing, currency stress, and institutional breakdown. This isn't theory. This is thousands of years of monetary history. Most observers won't recognize this pattern until phase 3 becomes irreversible. But understanding historical precedent makes the next phase predictable, not certain, but visible. This video is not financial advice. It is historical pattern recognition. If you want to understand these patterns before they unfold in real time, subscribe. New historical analysis every week.